This is the Savvy Investor radio show and podcast. For help with your retirement, schedule a 15-minute phone conversation with the team at ProStatus Financial Advisors today. Just call 866-597-1040 and at thesavvyinvestorradio.com.
It is that time of year, depending on who you're asking. March Madness, of course, getting ready to wind down. Pollen season for those that are affected, like myself. But more specifically, I'm talking about it being tax season. And the IRS, they're quite frankly not playing games. They've got their own set of rules that could take a big bite out of your income if you don't plan properly. Now, tax planning and tax preparation, two different things. But let's talk about that. What kind of tax traps do you guys watch out for that can derail a retirement?
Well, I mean, I think that, one of the things that people don't realize is that however much money you think you have inside of your 401k, inside of your TSP, your 403b, that's not actually how much money you have. If you have $1 million inside of your TSP or inside of your 401k or 457 or whatever pre-tax retirement plan you have $1 million in there, you actually only have about 750 because the IRS and the state own about, I don't know, between what, Lawrence, 20 to 30% of that account. They have a plan for taxes, even if you don't have a plan for taxes. And, some of the big things that people don't think about is there's these myths out there, and I would love to know where they come from, is that number one, Social Security is not taxable. Well, it is taxable. You can be, depending on how much money you make, your other sources of income, depending on how much all that other income is, you're either paying tax on 50% of your Social Security up to 85% of your Social Security at your ordinary income bracket. There's this other myth out there that at some point there is this magical age at which I no longer have to pay taxes. I can't tell you how many times people have asked me that question. Oh, wait, I thought at 85 or, at age 90, I don't have to pay taxes anymore. I said, well, I don't know where you've ever heard that, but you have to pay taxes. You're supposed to pay taxes for your entire life, depending on what your income is. And so, people don't often think about that. They don't think about, if you're taking money out of your IRA and, how it can affect the overall tax burden of everything else on your taxes. They don't think about how much it can affect my Social Security taxes. They don't think about, if I need $100,000 to come out of my IRA, that all of a sudden it's going to raise my Medicare premiums for that following year. My Medicare is going to jump up because I've crossed over their mythical brackets. Nobody ever really truly thinks about those required minimum distributions. That's the age at which you reach, which either going to be 73 for most people, or by the time we get to the year 2033, it's supposed to be age 75. And God knows they're probably going to change it thereafter, at which the government says you have to start taking money out. But what every financial advisor or most financial advisors, at least most of the ones that I have come across, is that they don't truly plan for taxes. They don't think about the tax implications of everything that's going on. And one thing that Mike and myself and Lawrence that we always say on the radio is, how can you choose to work with somebody that doesn't truly understand the tax consequences of the very investment recommendations that they are giving? And I have a great story of a number of years ago. I had clients, Lisa and Gary live in the Crofton area, and they came to a dinner workshop that we had done in Crofton years ago when I still did, quite a handful of dinner workshops. And one of the things that I always ask people to bring in when you're coming to see me for the first time is I want to see everything ahead of time. I want to see your investment account statements. I want to see your tax returns. I want to see your estate documents. That way, when you come and sit down with myself and my team here, is that we're going to have the most useful 1 hour conversation of your time, because I'm going to be able to address your specific questions to your specific situations. And they sent me all this information. And I was looking over their tax return, and this was 2015, 2016, right around that time. And I'm looking at their taxes, and I see that in 1 year, in 2015, I want to say this was, they sold a medical practice. She was a physician. She sold her medical practice to a big conglomerate. She sold it for about $5 million.
Okay.
Well, you can imagine the tax on $5 million on the IRS side was quite substantial. the tax on the Maryland side was quite substantial as well, to a tune of about $350,000. So I was looking at their 2015, 2016 returns, and this was in the year of 2017 when I was looking at everything. And I'm looking at the return, and the law for taxes used to say that before they changed everything right now, the SALT limitations, it used to say whatever you pay to the state in state taxes, you can deduct against your income in the following year. Well, since they sold the medical practice, right, they had no income that following year, but they had this massive, massive deduction on their tax return to the tune of $350,000 because that's how much money they paid to the state. And so I'm looking at their tax return, and I said to Lisa and Gary, I said, what is this negative $350,000 on your tax return that you had for that year? They said, oh, well, they just explained to us that was a deduction from the previous year. And since we didn't have anything, that's just kind of what showed up. And I said, so let me ask another question. When you sold this medical practice, what did you say to your investment people? They said, well, they were working with someone at Merrill Lynch at the time, and they went to the Merrill Lynch and said, hey, we sold our medical practice. What should we do? And she said, well, you should go talk to our CPA that we recommend that you use, so an outside person, and go talk to him about what you should do for taxes. So they went to talk to the CPA, and they said, okay, you're going to owe, $500,000 to the IRS and $350,000 to the state of Maryland. Just go ahead and write those estimates in and be done with it, and that'll be it. So then they went and did that, and they went back to the Merrill Lynch person and said, okay, we paid the taxes. What should we do with the balance of the money? She said, oh, well, let's just take it and invest it in these other brokerage accounts. We'll put some money in some annuities, things like that. And then they also decided they wanted to break the money up. They didn't want to just use the one person with Merrill Lynch. So they went to somebody at Morgan Stanley. They asked them, hey, we've got $2 million for you to invest. What should we do? Let's put in these various accounts. Let's invest the money. We'll use some variable annuities, all this type of stuff. Well, a couple of things that happened. And it took me about 5 minutes to find this massive error, a $350,000 mistake, and about 10 minutes to come up with what would have been a much better solution than what they would have done. So 15 minutes for me to see this, just because I understand how the tax code works, because taxes are such a crucial part of it. Well, that year, when they had that negative $350,000 on their tax return, they missed the opportunity to take $350,000 out of their IRAs and convert it over to a Roth while paying zero taxes on the transaction. Because if I have a negative 350 and I add 350,000, negative 350,000 plus 350,000 equals zero.
Right.
So they missed that opportunity because the one advisor from Merrill Lynch didn't think about it. The other advisor from Morgan Stanley didn't know about it because they don't work with taxes. Neither of them work with taxes. And the CPA firm that they were looking at, they are really good at history. They're really good at saying, here's what has happened in the past. Here's how we fix what's happened in the past. Not so good at looking forward. So that was a huge mistake of about $350,000 that they missed out on. And if you think that you're not getting the proper advice, if you ever go to your financial advisor and you're asking them questions about taxes, and they say, oh, well, I can't really talk to you about that. You need to go talk to my buddy, Tom, who's a CPA or an accountant over there on the other side of town. I encourage you, give us a call, 866-597-1040, 866-597-1040, and sit down with Lawrence, myself, and our team here at ProStatus, and we will put together your very own tax strategy that talks about ways that we can help reduce or even possibly eliminate the taxes that you are paying on your income in retirement. I have quite a few clients that we have gotten them down to 0% taxes in retirement, and it is entirely possible. All it takes is for you to pick up the phone at 866-597-1040, 866-597-1040, and see what we can do for you. See what a proper tax strategy can do for you and your family. And if you don't want to pick up the phone, you can always go to our website at thesavvyinvestorradio.com. That's thesavvyinvestorradio.com. Visit the website right there on the front page, right at the top, says schedule my 15-minute call right there. That's thesavvyinvestorradio.com.
If 15 minutes, there is a insurance company, obviously this is 15 minutes could save you 15% or more on car insurance. We're not talking about car insurance by any means. I am curious, though, the 15-minute call could show some things that could benefit you tremendously when it comes to taxation. What percentage, if you guys had to guess, of people who come in for the first time they're very concerned with market return and how the market is doing, that are also have taxes in mind as far as, this is what I could be losing in taxes down the line. How do I mitigate that? Is there a correlation? Is there a disconnect between those two?
Yeah, I mean, not a lot of people think about the tax consequences and what they've been saving in retirement, because most traditionally what you're doing is you're saving pre-tax. You've been saving, lifelong into these pre-tax vehicles for retirement. And they don't realize that, during retirement, when you're taking those withdrawals, now they're going to be taxed. And even if you don't need the money at a certain age, the government is going to require you to start taking that money. That's that RMD age, 73 or 75 for some of you. And what happens is now the government's saying, hey, all this pre-tax money that you've been saving for years and not paying taxes on, now you're forced to take it out and you have to start paying taxes on it. And what happens is you don't realize that that's a certain amount that you have to take out every year. Now that's going on the tax return as ordinary income. So that could make you bump up a tax bracket. That can make Social Security taxable. That can make, if you have a pension, your pension more taxable now, increase Medicare costs. So all these different costs are associated now with all this pre-tax money that you saved up. You're being forced to take it out, and now it's making your taxes jump up. So it's really just a tax snowball that's now happening, and a nightmare where now you can lose 30 to 40% of your portfolio value just due to taxes because you didn't properly tax plan, early on in retirement, right? Or while you were still working, you didn't look at what's a tax strategy that I can put in place? How can I start converting some of this pre-tax money, pay a little bit more tax upfront now so that in the long term, I'm saving in taxes, or I'm potentially getting to zero taxes in retirement to where I'm bringing in income and I don't have to pay taxes on it. And then there's an added layer to that. So then now we're also saving money for your heirs, right? When they inherit that money that you maybe didn't need in retirement, because you've put it in a tax efficient vehicle now, they're inheriting that money all tax free. So you're not losing that money to taxes. What we want to do, regardless of what side of the aisle you're sitting on, right? We know that the government are not good stewards of our money. Right. So why do you want to pay the government more and more money when you can keep that in your pocket, keep that in your family's pocket? But that all starts off with giving us a call, 866-597-1040. Like Ryan was mentioning, let us do a tax plan for you. Let us do an income analyzer for you. Let us come up with a strategy so that we can get that pre-tax money over to those tax-efficient buckets of money for you. But that all starts off giving us a call, 866-597-1040.
There's an adage, the market always comes back. If you have money in the market and you've got time on your side, historically, it has come back for the most part, and it's continued to grow. When it comes to taxation, when it comes to writing that check to Uncle Sam, and whether you know it or not, you do have a business partner in your retirement accounts in the form of Uncle Sam. Once you write that check, it's not coming back. And as someone who has had a lot of 1099s historically, I've never once written that check to Uncle Sam and said, gosh, I feel so patriotic right now. I feel like because I'm paying, it is not your patriotic duty to pay more in taxes than necessary. Obviously, April 15th, bear in mind that deadline. Do take care of your taxes there. But that is looking at history. That is looking in the rearview mirror. You want to also make sure that you are looking forward and avoiding any tax traps that could come down the line on that road through retirement. The team at ProStatus Financial, they can help you out with that. Again, 866-597-1040, or go online and schedule that 15-minute call right there at thesavvyinvestorradio.com. And we want to thank you so much for joining us here on the Savvy Investor Radio Show with Ryan Herbert and Lawrence Kiely. Hope you have a great day ahead of you. Gentlemen, appreciate you taking the time out of your schedule to spend with the listeners. And before we go, I want to leave you with the final word.
This is Lawrence Kiely. Thank you for listening to the Savvy Investor Radio Show and Podcast.
And this is Ryan Herbert. We'll see you, the Savvy Investor, next week.
Advisory services offered through ProStatus Financial Advisors Group, a registered investment advisor. Insurance licensed in Maryland. ProStatus Financial Advisors Group, LLC is not licensed in all 50 states. To find out if ProStatus Financial Advisors Group is licensed in your state, please call 410-863-1040. ProStatus Group, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through representatives of ProStatus Financial Advisors Group.